I did. Sure.
Hey, how you doing,
Hello.
my friend?
Hi, doing well, doing well. Good to see you. That's
Good to see
great.
you too. Perfect. Okay,
All
we got
right.
all sorted out. Yeah, you know what? I was sitting there, then I'm like, something feels wrong about this, so I'll give you a call just in case.
I'm glad you did, because yeah, the second person who said that. I'm not Michael Chow. I know you're not Michael Chow. I don't know. Something to do with Zoom. I'm clicking, I'm giving the wrong link, but so this works out well. So I got Phantom
No
here. Have you heard of
problem.
that one? It's a note taker and just records the message and it records the
Fathom,
meeting.
Fathom, I think, right?
Yeah, amazing stuff, amazing stuff. So
Yeah, yeah. I use it too. No stress.
good stuff. Okay, so let's get started.
That's
So
good.
so we're gonna edit a bit, but so what is it you want to talk about? What is it you don't want to talk about? What questions you want me to ask you?
I'm gonna talk about whatever. I think my main priorities that things I'm working on now are kind of my multifamily realtor business.
Good.
Um, Probably state of the market, kind of what I'm doing from portfolio growth, adapting in the market.
Nice.
Um, Challenges. I don't know. I'm good with whatever. Honestly, whatever you
Yeah,
want.
yeah. Okay. Give us stories. You know, people love stories. Oh, thank you. Yeah, people love stories. You know, I always ask how you got started and all that. So we'll be fine. All right, let's
Sure.
get started. Yeah. Thank you, Jack, for taking the time to on your busy schedule to speak with us and the audience and get to know who you are, what you do, and how you help others and make the world a better place. So, for those who may not know you, tell us about yourself.
Yeah, for sure. So I started off my career as actually a professional snowboarder
No
for about
way.
10 years.
That's cool.
Yeah, so that was a cool chapter of my life. I still feel it every morning, but nonetheless, it was fantastic. And then transitioned actually into being an entrepreneur and having a startup, which I sold, and then moving from that basically into real estate and kind of software sales, where eventually I transitioned into real estate full time. But I'm a 6 years, coming on 7 year veteran of real estate investing now, and have amassed just over a $12 million portfolio for myself,
Awesome. Well
and
done.
have been doing real estate full time now, which is fantastic.
Awesome. And your focus is on multiplex.
Yeah, so I'm a multifamily investor, primarily in Southwest Ontario, some more north, but all in Ontario, nothing in the United States.
Cool. And why multiplex? I mean, a lot of people start off with student rentals or duplex or rent to own. Why the multiplex?
So I did start off with that stuff. In primarily the majority of my portfolio is kind of residential multifamily. Why I think it's one of the best asset classes to own as you're growing your portfolio and amassing wealth is it's one of the easiest to leverage and to actually accumulate loans for. Um, and I think the way you can do it and use rental offsets and zero impact lending and some of the other tricks that some of the mortgage companies allow you to utilize help allow you to scale.
Yeah, that's cool. So cool. And I mean, with multiplex, there's a lot of. Can you give us a good story on one of your projects or what you worked on in the past? Because that's with multiplex, we're talking like six and up or 10 and more units in one building. That's a whole different profile of tenants. I'm sure you got a lot of good stories on how you picked something up and increased the value and fixed it up and tenant turnovers, all that good stuff. Give us a good story of what you worked in the past.
Yeah, so I'd say residential, from an operational standpoint, has an 80% overlap on the multifamily side to larger multifamily. So a lot of the principles that you learn on some of the smaller stuff you can bring over, and where we've kind of found the value in creating income and increasing the value of those buildings is what we call the value add approach. So
Mhm.
buying buildings that have low rents and then basically churning tenants, renovating units, increasing the NOI, and then boosting the value and essentially getting a more favorable cap at the end of it and stabilizing into long-term financing. Um,
You said a term which rings to my ears. It brings such joy. The NOI. Just elaborate on that for those who may not know the NOI because that is so important in multiplex.
Yeah, so I think there's 2 points, and to take it back a step even on how residential is valued compared to larger commercial multifamily. So call it the 4 units and under typically is valued more so on the comparable approach. So different properties in the area that have sold, they usually benchmark the comparables for about 80% of the number, and then use some other small tweaks and changes to kind of get to what the value of that asset's going to be. On the larger multifamily side, it's almost exclusively going to be on the net operating income and how much that asset is actually generating in profit and in income itself. Now, there's a bunch of different ways to kind of manipulate it and to grow that, but
Mhm.
essentially think about it like this. It's almost like a building qualifying for itself to be able to get its own financing. Just like if you were to go out in any other different asset class and purchase a business or purchase anything else, the business needs to support itself.
Mhm. So with multiplex, as some people may know, you're not qualifying for it. It's based on the income or the gross or the net operating income of the building. And one thing I like about multiplex is that it's not a question of whether or not you're going to get the mortgage or the financing for it. It's how much of the financing you're going to get. So what have you
For
found in
sure.
this market? Like what works with multiplexes on the financing part of it, with CMHC or like, what have you found? Like what market are you working on at the moment?
So I would say the majority of people right now are utilizing the MLI Select program in some capacity. The majority of
Mhm.
people have shifted away, I would say, from CMHC conventional, just because the way the point systems work, it's so advantageous to get that extra amortization or high loan to value when you refinance. Um, but because of some of the new CMHC rules and stipulations with having to um, have a lender for 2 years before if you're going bridge, it's created some different nuances. So you're seeing a lot more vendor takebacks on deals. And I would say almost 80% of off market deals right now that we're seeing in the marketplace have some sort of seller financing attached to them.
Oh yeah, that's great. We're talking what, 20, 10%, 10%, 20%? Is it, I've seen some that are 80%. What are you seeing in your takebacks?
We're seeing a fair bit of vendor takebacks where the seller is willing to give a full private mortgage on the asset with
Hmm.
usually 70% of whatever financing cost needs to be done. So essentially 20 to 30% down, depending on the asset. And a lot of the rates are pretty favorable that they're giving, anywhere between 5 to 10%, depending on the
Okay.
building and what purchase price. But there's always a give and take, right? If they're going to give you favorable terms, obviously they want a favorable purchase price.
Of course. Give and take. Why would they why would a seller provide some financing for the buyer? Like what's the idea behind that?
In the end, right now, we're seeing because of the way the market is and because of the way interest rates are, it's obviously driving values down. So for people to get the numbers that they've been looking for, they have to
Mm,
give extra incentive to the buyers to help them get across the line. Um, just as you mentioned before, the interesting thing about larger multifamily is you're guaranteed to get a loan. It's just how
yeah,
much.
yeah.
So if you analyze the deal and underwrite it, and you got to put 50% down on that deal, first of all, it throws out your leverage on the deal. And typically on your IRR calculations and your total return, it's also going to throw it out too. So what most people are doing now in the marketplace, and seems to be the sweet spot to make the most amount of money, is to buy a value add apartment building that has 50% or more upside on rents, bridge that asset with either seller financing or with some sort of bridge institutional lender,
Hmm.
stabilize the asset over a 12 to 18 to 24-month period, and then once stabilized, and transition that asset into CMHC for long-term financing. And in a lot of cases right now, pull a fair bit of money out and recycle that into the next deal.
That's awesome. I mean, that's a lot there for those who may not know. I mean, that's we could talk about this whole subject. It could take a whole week and just talk about that. Where first, let's bring it back. Like, where do you find these assets that are 50% lower than the market value in their rents?
So multifamily is weird in the sense where if you have a building that has really high rents and you've done great renovations of the building and it be what someone would call very stabilized, the addressable market for that asset is actually very small. So in some circumstances, it actually makes sense to not fully renovate a building and not churn all the tenants if you actually want to sell that to get a larger addressable market who actually want to go and buy that building. And I
So
would say
you're saying that multiplexes that have been somewhat neglected will be more appealing for investors, and there'll be more of a bidding war. Is that what you're saying?
absolutely. That's where the market's driven right now. The only people that typically want to buy these stabilized assets are people that want to park money. And who are the people that want to
Yeah.
park money? It's institutional investors, REITs, funds, or high net worth families. But the
Mhm.
majority of people like us, we want to be recycling our capital. And the only way to do that is to buy these buildings that have what we call value add, which is either on the rents or on the renovation side.
Okay. So give us an idea of how you stabilize it. You said 12 to 18 months. Um, Not a lot of people obviously are aware of the laws in Ontario. It tends to favor the tenant. How do you go about turning over tenants?
So when you're looking at buying a building, people will pay a great premium for vacancies. If you can find a building with vacancies, obviously that helps right off the bat because you do get some tenant turnover there.
Mhm.
But the majority of the strategy that people are utilizing is typically cash for keys. And on the residential side or smaller stuff, we'll pay anywhere on average maybe ten to $15,000 most for cash for keys. But on the larger stuff, we can go sometimes up to $40,000 to $50,000 because the increase on the rent with the cap multiplier can end up increasing the building's value by 100 grand, 150, 200,000. And we've actually done
Yeah,
that several times.
that's amazing. It's amazing. But I think we need to go into numbers now because this calculation is remarkable. For those who don't understand it, it could be somewhat bit too much, but this is remarkable. So can you give us some numbers, Jack, on how this works? On every time you increase the rent by say $100 a month, how does that bring in the value of the building? How does that increase the value of the building?
So you're going to take what the cap rate is essentially that you think basically you're buying the building at, or what it's going to be stabilized, and you're going to multiply it by whatever the increase is. Um, and on our buildings, depending where we buy, we usually want to have a lift of around 50%. And typically around the GTA, which is where we don't buy, we're kind of just outside of it. Call it the Hamilton, the Barrie, Brantford, um, Orangeville type thing.
Yep.
We're looking at buildings that have average rents of around $1,000 or under. That
Hmm.
market rent is typically going to be around 2,000 per unit.
Neat. Okay. And so say the rent is increased. Say you're able to rent increase to 1,500 rather than 2,000, but it's like 1,000 to 1,500. That's $500 per month for that one unit. How does that relate back to the valuation of a building? If the cap rate is 5% in that area, like just to make a quick calculation.
Yeah, so you're going to divide the cap rate by the amount of increase on it, and then it's going to give you a valuation increase on the building. Um, there's a bunch of different things too on how you can kind of manipulate it and try to do it. So certain units we will churn and certain units we won't. And it depends on the buildings too. If some have rent control on some units and some on others. Now, I know the government's trying to get away with this with changing how some of the MLI program works in different areas for
Yeah.
what the stated market rents are. And we have a couple buildings that have that, but the timelines for being able to do that are going to kind of close, and I'll explain exactly what that is. So,
Okay.
in some areas in Canada, you can go and buy a building where CMHC says it has to be below market rent, and you basically keep a portion of the building that's locked in for low income. But the low
What
income,
percentage? What percentage? 25? Like it depends on.
it depends on how many points you want per the MLI qualification that you're going for. So some
Okay.
people do partial low income units, and then we'll also do some of the environmental stuff. But it just depends on what your strategy is for how many points you're going for. in your
And
amortization.
the MLI Select, what's the purpose of this MLI Select that is given by CMHC to the developers? Do you, what's the reason why most people would actually want to be in this program?
So the reason why you want to be on the program is a couple things. It's going to allow you to stretch your amortization typically longer than you would with normal conventional CMHC financing.
Hmm.
The loan to values that will allow you to refinance the asset out are up to 95%, which we've never,
95%.
it's incredible. Yeah, we've never seen it on any other product before where it can allow it to that amount. And there's a couple little cool pieces of it too, where you can also lock in your term for 10 years. And then also, because it's a CMHC insured mortgage, you do get a favorable rate.
So when you say amortization, amortize for how many years?
So you can get an amortization up to 50 years in the program.
Well, 50 years. That's unheard of. So that really brings the cash flow nicely.
We're not sure how long the program is going to be around for. So people who are sizing up their portfolios from residential into larger multifamily are taking advantage of it. The biggest thing that people need to take into consideration when going down that route, as long as they're doing it Ontario, you pretty much have to go through kind of the environmental route, which means renovating to be able to make the building more environmentally friendly, which is very costly.
Okay.
So where it comes down to is making sure you have the right power team to be able to underwrite accordingly and then be able to bring that value. But overall, it's a fantastic program. I don't know how many billions they've already put out on it, but it's been out for about a year and a half, and a lot of people, I would say 90% of the market's using it.
So it seems as if the government is trying to manipulate or influence the market to get people to buy and renovate and bring it up to par on environmental note as well as for low income housing, but also give it favorable for those who do so by extending the refinancing, well, extending the amortization and also getting a favorable refinancing position, which is amazing. You can pull out 95% of your money. You say that's so cool, and leave about.
So it's a bit of a it's super interesting because the way that they make you do it as an investor is a little bit counterintuitive towards the government policy that they're pushing. So you
Okay.
have the federal liberal government on one side saying that they want to help tenants and that they want to keep people in units and that they don't want people to churn and renovate and essentially do what people would call renovictions now in the media.
Yeah.
But when you look at how CMHC actually qualifies these buildings and what they require to get into their program, it requires units being churned. And when you churn a unit, the byproduct of that is having to raise rents to market. So it's an
So
interesting
what
concept.
about those who say, well, technically, if you look at the laws, they have complete rights, tenants complete rights to come back at the same price that they left after a year. What about that? What about that situation? Does that happen?
It's hard. People do it and they do come back. But the one thing that people forget about that situation is if someone does go and they get put on what's called an N13 and
Yep.
they move out somewhere with all the intention of moving back, they have to sign a 1 year lease somewhere else and they're binded by that 1 year lease. So if the renovation finishes in 3, 4, 5, 6 months and they have 6 months on a lease that they can't afford to buy out, the majority of people just end up staying or going down that route.
Hmm.
That's not our preferable method of doing it. Ours is still the cash for keys, where we find it's a more mutually acceptable, kind of procedure to get someone out. And typically they leave on better terms and take better care of the unit, things like that, as they're incentivized to do so.
Awesome. That seems very generous and much better approach. Can you provide us some stories about the cash for keys? Because I hear a lot of people talk about it, but sometimes it's a lot easy. Sometimes it's kind of challenging. So what do you find in this market?
We always, obviously you don't start at your highest, you start lower and kind of see where people want. I would say the sweet spot where most of the time we get people out is somewhere between 5 to 6 months. So whatever the rent is that they're currently paying, 5 to 6 months multiplier of that typically is pretty good to get someone out. Once you hit five figures, it really opens people's eyes. So once they see kind of the
Hmm.
10,000 plus, it really gets a lot of people moving. But I would say even on the residential, the smaller multifamily, we've gotten people out for 3,000, 4,000, 5,000, 6,000, 7,000. Um, but as
Is there a
landlords,
procedure that you follow? Is there a way? Do you send out a letter in the beginning, or do you just knock on the door, talk with people, and then have wads of cash on you? I mean, I've heard many tactics, I've heard of many tricks, and I've heard of many ways of going about it. What's your way?
we're not out to deceive anybody. You know, we go to people and we just say, hey, listen, this is our plan with the building.
Yeah.
We're going to be doing renovations. There's going to be a lot of headache going on here, and we're pretty transparent and upfront with them. Usually you'll kind of get a first round of people that are interested in leaving right off the bat or have been thinking, hey, you know what, maybe I would leave, in a little bit of money kind of helps them make that barrier. The next round of people, you know, sometimes are a little bit more stubborn. They might be a little bit more educated from hearing stories about people getting good paydays. And they
Hmm.
play the game a little bit about going back and forth and eventually end up settling usually at a reasonable number with those people. And I would say those are kind of like the next tranche of 33%. And then the last 33% of people are sometimes very difficult where they've lived in a unit for 20, 30 years.
Yeah.
And you got to sympathize with them sometimes because even if they get, you know, 12 months of rent, because they're so under market, it's super hard for them to go anywhere. And they might not be
Yeah.
able to qualify and all the rest of it. And typically those ones are the ones that end up having to get a higher payout.
Yeah, and I agree. You said it nicely, where you got to empathize with these people. It's not, I mean, you're running a business and you want to make sure it works. And then what usually I find is some of these units are neglected, especially if they've been there for 20 years. It hasn't been paid in 20 years. It's bare minimum. It hasn't, nothing's been done to it. It needs to be renovated. So it's in everyone's best interest to kind of turn things over, and then also make it sure that it's market rent. So I see it has to be a win-win situation. Now, what obviously you don't do this alone. You work with investors. What kind of investors are you looking for in order to make these projects happen?
So there's two sides on how we work with people. So we work with LP partners where we bring people who want to have exposure to multifamily in this partnership with us, where they can co-invest directly in buildings, or they can invest through a fund that I work with Mike Rockall and Mark Baltazar called Peak Multifamily. And that's
Yes,
more of, yeah. So, you know, if
good
you're
guys.
someone yeah, exactly. Great guys. So if you have, you know, let's say a job and you want some exposure to multifamily, but you're not a full-time real estate investor and don't necessarily feel like you have the skill set to be an operational partner, a lot of people go down that route. The
Mhm.
other way we work with people is on the broker side, where we transact in a lot of off-market, smaller residential buildings and also larger buildings. Our sweet spot, I would say, is 10 to 50 units, but sometimes we'll go up to 100 units. And we basically provide underwriting services to those people and handhold them through finding deals all the way to closing and actually tenanting out those units. But it really depends on what that investor wants and, you know, what kind of operational experience they have, I would say.
Yeah, what kind of investors are there? Are they dentists, doctors? Are they lawyers? Are they people who just don't want to get their hands dirty? What are they typically looking for?
Obviously, people are looking for return at first. I would say most of our investors that we have now um, are actually people that already have some sort of real estate exposure. So they've seen the fruits of what real
Mm.
estate can provide. A lot of them actually, for our specific investor group, I would say are younger professionals. So people that are kind of coming in to their 30s and 40s that have been successful either in tech careers, you know, finance, investment banking, different things like that. And then we also have people that were just regular kind of folk that built great residential portfolios and want to get exposure to larger multifamily now.
Cool. That sounds like a lot of fun. And what can they expect working with you?
So from a return standpoint, we give anywhere between 12 to 15% annualized return. Um, from the fund standpoint. If you do a direct investment in the deal, it can vary, between higher or lower, but you have direct ownership exposure as an LP to a specific asset. So you can invest in a chunk of buildings through the fund, somewhat like a mutual fund if you think about it,
Mhm.
or you can be a limited partner in that apartment building and actually own a specific chunk of it. But to do that, you need to be what's called an accredited investor, whereas someone who wants to invest in the fund can be any retail investor, anybody with registered funds.
Yeah, this is good. Accredited investor. I like the term. Can you elaborate on that term? What does that mean for most people?
So the government came out with the term of an accredited investor a while back because people were putting themselves in investments that they couldn't necessarily financially support if the investment went bad. So it's a layer of protection that the government has put in place that basically says you have a certain amount of income, investable assets, or net worth that hits a certain threshold. And if you don't hit that threshold, then the investment most likely isn't suitable for you. So we take our investors, whether they have that accreditation or not, and we can actually help walk them through that process if they do qualify for it. And if they don't, we try to get them exposure either through the fund or getting in on the ground, buying maybe a smaller building for themselves.
Oh, cool. So you're a realtor as well. Is it group like Peak Investment is also an realtors as well, brokerage?
Exactly. Yeah. So we have a kind of three-tier of service. So we have an advisory business that helps people scale their portfolios, either buy multifamily or scale their portfolio from residential to multifamily.
Cool.
We have a brokerage division where probably move around 1,000 units a year. And then we also have our investment vehicle, which is where we're an asset manager on the side. So anybody who wants exposure to multifamily, we can kind of handhold you through the process, whether you want to be a passive investor or an active investor.
That's pretty cool. Another thing I like about multi family investing is, as you mentioned, after 12 to 13 months, you stabilize the building and then you refinance. I feel a lot of people are surprised by that refinancing part of it because they get their money back. And often when they get their money back, they're wondering, am I still part of the deal? So how do you elaborate on the refinancing? At what point does it occur? And how do people react with the refinancing? And how does that work with your investors?
Yeah, typically investors get paid back first. So obviously, an important thing to investors being able to recycle their capital back into the next deal. It's not guaranteed that on every single deal on the refinance, you're going to be pulling all your capital out, as there's some deals that are still fantastic deals, but make sense to leave some of the money back in the deal. And then typically any asset is between a 5 to 7 year hold where that partner is going to be involved with the process on that deal.
Hmm.
Around the 5 year mark, unless agreed upon by all partners, typically the building will have a review period. And then if it makes sense to either divest of that asset, then that's what happens at that point. And if it makes sense to hold it again or refinance it again at that point, it's kind of up to the partners to decide.
So after 5 years, it's decided whether or not to either sell it or refinance, pull some money back out, and do it again.
Correct. On the direct investment, what's called the syndication side, that would be the strategy. On the fund side, it's a what's called an open-ended fund. So the fund doesn't have a close date for the raise. And essentially, we'll just be reinvesting the money it gets from refinances and perpetuity into buying more assets.
That sounds so cool. That sounds really fun. So, I mean, this is we've been talking for quite some time. Very smoothly as well. You know your stuff. I was quite stunned or shocked by the fact that your background is in snowboarding. So how does snowboarding help your current career at the moment?
You know what? It's actually interesting. I think a lot of professional athletes, especially people that were on the extreme sports side, transition very well into business and also real estate
So
because
what
of
this,
the
sorry to interrupt. The were you competing in snowboarding? Like what level did you do your snowboarding?
yeah. So I was competing at a national and international level and was
Cool.
sponsored and doing that, for my career for about 10 years.
Awesome.
Um, and was doing the discipline of slope style. So basically, it's a combination of jumps and rails as you go down a run. You do different tricks and get judged off it. And yeah, just super fun,
That
painful
seems
at times, but
like a
very
lot
fun.
of fun. I've seen it. I've not tried it. A lot of fun. I'm an avid skier. I love skiing and snowboarding. So it's that sounds a lot of fun. So how did um, that fun time, I guess, or that competitive nature, the athletic in you, help you become a business person?
One of the good attributes I think of it is being able to block out when your body or your mind is telling you no, not to do something, being able to override it and kind of push
Mm.
through, right? And in real estate and in any other business, every day is about problem solving and overcoming problems, and sometimes pushing yourself out of your comfort zone and through boundaries. Every level you go through in real estate, there's always someone who's going to be bigger, and you're always aspiring to be. And the cool thing about it is you can stop at any level and be super successful. But if you're ambitious and want to keep going to different levels, you always got to be pushing yourself out of your comfort zone. And I think the skill set you get in snowboarding of being able to do that effectively transitions very well into real estate.
That's awesome. Well put, because the mindset is so important. What other things did you learn along the way that's helped you in the real estate in regards to mindset? Because I find that that is really what keeps people back. Is just their mental patterns, the way they think about certain things, and as you mentioned, how they overcome certain obstacles or they don't.
I think the mindset part is probably one of the most important parts. You can get discouraged at any point of your journey. It's about how
Mm,
you pick yourself up, right?
yeah.
Um, you could be the best realtor, the best investor, the best asset manager, and at some point something's going to go wrong. And the only thing that differentiates you between someone who can't pick themselves up and someone who does is you. In the end, no
Cool.
one's
Well
going to
put.
come in and save you, right?
No one's gonna come and save you.
And then
So
the other
yeah,
thing
that
too with real estate
yeah.
is scaling with caution. I think there's a lot of people out there who've heard a lot of stories, especially in the past 6 to 12 months, of people who maybe grew their portfolio too fast. They over leveraged and they didn't have
Mm.
certain risk parameters in place. And unfortunately, those people, are closing up shop and have lost investors' money and things like that.
So
And I
so
think,
so how do you minimize that risk as a business owner,
I
as an
think
investor?
safe. Good question. Good question. So I think growing safely in the ability to have cash reserves, I think is super important. And then having a team around you that can also help execute um, on a deal specifically that has a skill set that maybe is above that specific deal. So people who have already gone through a transaction like that, or have advisors who can advise on a certain transaction, um, or portfolio growth or whatever it is, that can already help mitigate problems that they might have seen before in their past. And I think one of the biggest things too is just cash reserves.
Yeah, seems like cash is the great king now. Everybody likes to have, even lenders want to see a lot of cash in your bank at the moment. You mentioned about the team. Can you elaborate more on the team?
Yeah, I think it's a super important part of it, being able to have someone that has a skill set that they can bring together. So making a team, especially in real estate, as you're building a portfolio, a fund, or raising money, it's good to have people that have different skill sets and not the same, but they also need to be able to complement together. And I
Mm,
think specifically on multifamily, having someone who's really good at raising money, um, someone who's really good at operations, at contact, whether it's internal to the team or external for underwriting and being able to look at numbers.
mhm.
Um, and then someone that can kind of glue everybody together. And I think at Peak, we've done a great job at being able to do that and bring a fantastic team together that has different skill sets. Um, and it just worked really, really well at kind of a safe growth pace.
Seems like you're enjoying it as well.
We do enjoy the journey. It's, even with how the past 2 years have been with interest rates and bumps in the market, I think the way that we structured, the portfolio and my own personal portfolio and things
Yep.
like that allow me to sleep at night. Whereas maybe people that leverage in different ways or took high yield debt, got in a little bit tougher situations. One thing that's super interesting that I think a lot of real estate investors gap on is they become really good at real estate, but they don't look at the business aspect or the economic aspect of it. And they get so narrowed down of just like buying real estate that they don't look 6 months down the road or 12 months what could happen. And they get
Yeah,
so caught up in a deal or whatever they're working on that they get caught with their pants down.
that's not pleasant. So you're talking about the operation of things.
More so from an economic standpoint, right? Like rates rising when they were, there was economic indicators, a year before where most large
Mm,
asset managers started divesting of bad assets and securing different loans and making preparation for a rainy day, whereas a lot of other investors who were so in the weeds just on the real estate portion and acquisition didn't see any of those indicators coming and weren't able to make kind of adequate changes to buffer their
yeah.
portfolios.
Hopefully they've learned from that because yeah, 2022 seems like everybody was making money. No one was talking about anything downturn. Yes, of course. Last question. Currently, we're 2024. What do you see this current market? Is it opportunity? What do you see at the moment? Is it a downtime? What's your current take on the market?
If you're an investor and you have money, there are so many deals out there, and it is a fantastic time to be a buyer. I can't stress that enough.
Mhm.
You just need money and dry powder in this market, and you can get some fantastic stuff. Uh, I foresee rates staying higher than people think. I don't think we're going to get a rate decrease in June. And I think
Oh
even
no.
if we start,
Okay.
I do think that even if it pushes out and we do get rate decreases this year, the lagging effect of it isn't really going to start moving the market for another 12 to 18 months.
Okay. That sounds interesting. Yeah, that sounds good. How do people find you, Jack?
So you can reach out my website at www.burnstonecapital.com, or you can follow me on Instagram at Burnstone Capital. You can also check out Peak Multifamily Instagram page or our website, peakmultifamily.com.
Awesome. Well, thanks for taking the time. This has been really a lot of fun, and you know your stuff. So congratulations, and keep going. I think this is awesome. You'll do very well. But I'd like to see you snowboard as well. I think that'd be pretty cool.
We'll have to get it on the slopes one day next season. Hopefully, we'll
That'd be
have
cool.
some
Yeah,
better conditions.
Whistler or Mont Tremblant? What's your preference?
Whistler's better, but Trombon's closer, so I'm good
It
with either
is. I
one.
agree. Much closer. You can at least you can drive. I can drive from where I'm at. That's great. Okay, so good talking with you, Jack, and we'll definitely chat again.
Thank you so much for having me on the show. I really appreciate it.
You're very welcome. Thanks. Bye bye.
Cheers.